Ladies and gentlemen, gather around and prepare to embark on an unforgettable journey into the exhilarating world of stocks and financial wizardry. Welcome to Stock Marketpedia, where the stock market meets showtime. Let's kickstart this electrifying adventure together and redefine what it means to be the stock market superstar. So without further ado, hit that play button, fasten your seatbelts, and let the financial extravaganza begin. Get ready for a wild ride because Stock Marketpedia is here to rock your world. Peter Lynch, renowned for his exceptional performance as the manager of the Magellan Fund at Fidelity from 1977 to 1990, is highly regarded in the investing world. His book One Up on Wall Street is considered essential reading for value investors and is among the best-selling stock market books ever written. Although Lynch doesn't often give interviews, his past commentaries provide valuable insights that are particularly applicable to the current market conditions continuing through 2023. One of the significant challenges we face in 2023 is the combination of high inflation and rising interest rates, which is negatively impacting asset prices such as stocks and real estate. Surprisingly, Lynch's perspectives on investing during periods of inflation and rising interest rates are remarkably relevant to today's environment. Peter Lynch's 2023 investment tips.
But I don't think people understand there's a 100% correlation with what happens to a company's earnings over several years and what happens to the stock. If the company, McDonald's, has done very well as a company, right, the stock has done very well. People worry about too much money supply, what's happened to the price of oil, who's the president, who's being nominated for the Supreme Court,
it's all
the
earnings.
ozone layer. It has nothing to do. McDonald's earnings go up the next 10 years, the stock will go up.
Yeah, but what they will say to you, Peter, is that, as you know, and why am I telling you this, but it's fun to tell you this, they're telling you that these other things influence the amount of earnings of a particular company. Yep. If we're in a recession, people are not going to spend as much money on going to the movies or whatever they do.
Right.
And therefore, you got to pay attention to these other things because they impact on earnings.
They are very important, but you have no idea of knowing what they're going to do. Alan Greenspan's the head of the Federal Reserve.
Right.
He cannot predict interest rates.
Yes.
He'd be the first to tell
He can
you.
influence them, but he can't predict them.
He cannot predict what long-term interest rates are going to be 1 year from now, 2 years from now, 3 years from now. He's even surprised how low they are now.
Right.
So how am I supposed to predict interest rates? How am I supposed to predict the economy? You certainly remember the recession of 82.
Yes.
In 1982, we had a 20% prime rate, 14% unemployment, 12% inflation. I don't remember anybody telling me in 1980 or 81 that was going to happen. All of a sudden, we had the worst recession since the Depression. I didn't read about it in the paper. So it's crazy to think about these things.
Invest now or adopt a wait-and-see approach. Given the current market decline of 15%, there is a question of whether it's advisable to adopt a wait-and-see approach or take advantage of the discounted prices and make purchases.
Well, we had a huge run. I mean, the market was 4,000 just 2.5 years ago, and it ran up to 8,300 in August. And like any big rally, sometimes it backs off. I mean, it's healthy. In fact, I'd rather have gone down 1,000 points than gone to 12,000. If you look at Japan, Japan went from 5,000 to 15,000 on their Dow. And it was fairly priced at 15,000 on earnings and everything else. Then it went to 40,000. And that caused 7 years of inflated real estate, people overspending. And basically, they've been in a recession for 5 or 6 years because the market went up too high. I mean, if the market goes up too high, if the market goes too high, you're discounting earnings 7, 8, 10 years out.
In recent years, the story has been characterized by low interest rates and a booming stock market. However, the current situation is different. With interest rates rising and the stock market experiencing a decline, Peter Lynch emphasizes that investors should not be overly concerned about this shift. He views the market downturn as a healthy occurrence. Typically, when the market is hot, conducting discounted cash flow analysis often leads to the conclusion that a stock would need flawless performance over the next 5 years to justify its current valuation. Conversely, when the market declines, the tides turn in favor of long-term value investors. Therefore, it's crucial to maintain a focus on the long term and not be swayed by short-term market fluctuations. Focus on details, not macro. The main message that Peter Lynch conveys is that while the macroeconomic factors and their influence on prices are important, they are beyond an investor's control and difficult to predict accurately. Therefore, he advises against spending excessive time and energy thinking about macro trends. Many investors have fallen into the trap of being consumed by macroeconomic news, especially in the current year where discussions about the Federal Reserve's meetings and interest rates hikes, as well as CPI data from the Bureau of Labor Statistics, dominate the media. However, Lynch emphasizes the need for investors to maintain a laser-like focus on evaluating individual investment opportunities independently. Each potential investment should be carefully assessed based on its own merits rather than being overly influenced by macroeconomic noise.
Stocks are not lottery tickets. There's a company behind every stock. If the company does well, the stock does well. It's not that complicated. People get too carried away. And first of all, they try and predict the stock market. That is a total waste of time. No one can predict the stock market. They try to predict interest rates. I mean, if anybody would predict interest rates right 3 times in a row, they'd be a billionaire. Considering there's not that many billionaires on the planet, it's very, I had logics, I had a syllogism and studied these when I was at Boston College. There can't be that many people who can predict interest rates because there'd be lots of billionaires. And no one can predict the economy. I had a lot of people in this room were around in 1981 and 82 when we had a 20% prime rate with double-digit inflation, double-digit unemployment. I don't remember anybody telling me in 1981 about it. I didn't read, I studied all this stuff. I don't remember anybody telling me we're going to have the worst recession since the Depression. So what I'm trying to tell you, it'd be very useful to know what the stock market is going to do. It'd be terrific to know that the Dow Jones average a year from now would be X, that we're going to have a full-scale recession, or interest rates are going to be 12%. That's useful stuff. You never know it, though. You just don't get to learn it. So I've always said, if you spend 14 minutes a year on economics, you've wasted 12 minutes. And I really believe that.
Peter Lynch's famous quote drives home the point that while macroeconomics plays a significant role in the functioning of the world, it shouldn't be the primary focus for long-term value investors. He highlights the example of missed opportunities during the period of higher interest rates in 2007, where investors who avoided companies like Amazon, Apple, or Google due to interest rate concerns would have made a poor decision in hindsight. Even in the current market downturn, there will be investors panicking and selling off their portfolios out of fear of rising interest rates and potential stock market decline. However, Lynch reminds us that the key focus should be on analyzing the earnings of individual companies. Understanding their profitability, growth potential, and ability to generate cash for shareholders becomes crucial in making informed investment decisions. Emphasize valuation. Peter Lynch acknowledges that in recent years, there have been numerous exceptional businesses in the market. However, their prices have been inflated to such high levels that they would have needed flawless execution and exceptional performance over the next decade to justify their valuations. This aligns with Lynch's perspective on the importance of considering the fundamental value of a company and not just relying on future expectations or market hype when evaluating investment opportunities.
Just think of this as being, you say to yourself, I think this company's going to earn something in the future. If it's already discounting that, if it's selling at a huge multiple, you say it has to work, and then it's only going to stay even. So you have to say to yourself, if I'm right, how much am I going to make? If I'm wrong, how much am I going to lose? That's the risk-reward ratio. In Stock Shop, we talk about, if I'm right, I hope I'm going to double, triple my money. If I'm wrong, maybe I'll lose 30, 40%. That's a favorable ratio. If you say, if I'm right, the stock's not going to go up, it's already discounting terrific things. If discounting terrific things are already in the stock.
The key to successful investing in 2023 lies in closely monitoring valuations. It's important to identify companies that are both exceptional in terms of their performance and undervalued, providing a favorable risk-reward ratio. Peter Lynch emphasizes the significance of investing in stocks that have a lower valuation than their calculated intrinsic value. By finding wonderful companies that are priced significantly below their intrinsic value, investors can take advantage of their current market weakness. Calculating intrinsic value is a complex topic.
One thing you're trying to do is say, of all these public companies out there, here's the company I really like. The fundamentals are terrific. Their earnings are doing well. Their competitors are doing poorly. I think this company's doing terrific. And all of a sudden, the stock might have gone from 40 to 30 because of this decline. That would say, wow, here's a chance to buy it. So you're trying to say some companies might have been overpriced at 60 and all they did was go to 50 and say, big deal. So you're trying to find companies you liked anyway. Right now you liked them. And now they've had a haircut. That's what you would do. Not a stock that went from overpriced to fairly priced. Something that was fairly priced at the start of this exercise and then had a very, a 5-for-4 sale.
Therefore, the focus should be on identifying companies that are currently undervalued and available at discounted prices. These are the companies that were previously priced fairly but have now entered the realm of margin of safety due to market movements. It's important to avoid getting overly caught up in macroeconomics and allowing it to deter us from our proven long-term value investing strategies. Investing with a long-term vision.
When I ran Magellan, I might have been right 6 times out of 10. But if I'm right, I make a double or a triple occasionally. It offsets the times you lose 30 or 40%. In fact, you could be right a third of the time as long as you have a lot of good results. So that's, when you're short, you can only make 90%. When you're long, you can make 10-fold or 5-fold. So I think long is the way to be. I think the market is fairly priced on what's happening right now. You have to say to yourself, it's 5 years from now, 10 years from now, corporate profits are growing about 7 or 8% a year. That means they double, including dividends, but every 10 years, quadruple every 20, go up 8-fold every 40. So I think that's the kind of numbers you're interested in. That's better than 10-year bond today is a little over 2%. So I think the stock market's the best place to be for the next 10, 20, 30 years. The next 2 years, no idea. I've never known what the next 2 years are going to bring.
It's crucial to understand that predicting the short-term movements of the stock market is impossible. While the market may experience fluctuations in the next 2 years, the long-term trajectory becomes more evident over extended periods of 10, 20, or 30 years. As businesses become more productive, increase their earnings, and potentially raise their valuations, stock prices generally tend to rise. So the key is to maintain a long-term perspective and keep an eye out for companies that stand out as strong investments. These are the companies that you don't understand. Well, they have a competitive advantage and are led by effective management teams. However, the most crucial aspect is finding companies that are significantly undervalued compared to their intrinsic value. By focusing on these factors, you can identify solid investment opportunities. That's a wrap for today's video, but the excitement doesn't stop here. Get ready for more mind-blowing content coming your way. We'll be pumping out videos 3 to 5 times per week, so buckle up for an exhilarating ride. Drop your comments below with your topic requests because we want to hear from you. And don't forget to smash that like button, subscribe, and hit that notification bell to stay in the loop. Stay tuned for the next thrilling episode on Stock Marketpedia, where we make stocks sizzle.